It was a disappointing day on Wall Street. We woke up to positive news regarding some trade talks between the United States and China. Dow futures, S&P futures off to the races. Well, as the day unfolds, we find out that what's new? Democrats and Republicans bickering once again, as we saw President Trump kind of going back and forth with Schumer and Pelosi and others, and that kind of threw a wet blanket on any sort of a rally that we had going prior to that. So anyway, as it stands right now, we kind of finished flat after a really robust open. We remain bearish with our postures across the board, and for the most part, we're still trying to find a bottom out there. It's been elusive, and we're still not there yet. So what I thought we would do today is look at an area of the market that has struggled a little bit more so than other areas and tap into a bearish trade idea. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 11th, 2018. First of all, for those of you that are new, welcome aboard. We're grateful to have you in our audience here tonight. Remember, you can subscribe to our YouTube channel, and while you're there, make sure you're signing up for our email distribution list as well, which entitles you to all of the overbought and oversold cluster signals in the S&P 500. In addition to that, we're heavy users of Twitter. Make sure you're following us there. My handle is @BrandonVanZ. Make sure you click like and retweet if you get value out of these daily videos as well. And then in addition to that, we have a Facebook presence. Check out our group web address embedded in the logo in front of you. All right, with that, let's go ahead and take the charts for a spin here today. As you can see, I've got chart 4B pulled up in front of us for those of you that are Premium Market Scholars subscribers that want to follow along today in the presentation. So this particular chart setup is just a 4-grid that's showing us one key indicator that we like to kind of focus on in this video, which is the market forecast indicator. That particular indicator you can find on TD Ameritrade or Thinkorswim resources, but as you can see here, we've kind of customized it to make it a little bit more visually pleasing and a little bit easier to decipher as well. In particular, you'll notice the colored backgrounds of each of the 4 charts. When you see a red background or a pink background, assume that the posture that we are looking at would be considered to be bearish. If you see a green background, those are times when we would consider those to be bullish. Now, normally, when you're setting posture, you're hoping for some sort of a good aggressive trend, either up or down. But of course, that is not what we have been experiencing for the last, let's call it 2 or 3 months. It's been more chop and slop. So, most technical indicators, of course, are going to look at past data to try to present some sort of a picture of the future based off of the trend of that data. Well, again, when we have kind of big moves up like we saw here with the S&P 500 from, let's call it here in late October until, let's see, first week or so of November, then your posture turns bullish there. As you can see, the background color would have been green at that time. And then, of course, immediately reverts back down to those same levels, but this time in kind of mid to late November. Turns bearish at that point and then right back up, so you can kind of see the problem with that. Anytime we have this chop and slop where direction over the long term is really going nowhere, but in the short term you're kind of seeing these big chops up and down, it tends to kind of have that confusion with many technical indicators, including this one. So as it stands right now, our posture is bearish on all 4 of these indices. You can see the S&P 500 closed just barely lower today. It was down 0.04%, and you can see that background color of our chart is pink, telling us that we do indeed have a bearish posture using that green intermediate term line down here. Remember, when it's pointing lower like it is right now, we consider that to be a bearish posture. But I'll also caution you that, the last 2 times we were in this general vicinity price-wise, right back here and right back here, it wasn't too long until after that we had that chop back higher. So, I have no reason to believe that won't happen this time around either. But we'll look at this every single day, as we always do, to try to pick up on clues here as well. Remember, we are in a more bullish time period from a calendar perspective right now. Typically, November through January is the best 3 months of the trading year, according to Stock Traders Almanac, if you go back over history. But of course, that doesn't happen to happen every single year. There will be plenty of years where it could be the exact opposite of that. So we have to be mindful of that as well. What we do know factually is that This is a market that has struggled to have any sort of a true rebound to get us back into those bullish trends that we saw earlier this year and, of course, all of 2017. So it's been a more frustrating market, I guess you could phrase it as. You'll notice as it stands right now, we also have red moving averages on all of these 4 charts. Now remember, those moving averages will change colors based off of a couple of different philosophies. If you have a green moving average like we did over here, notice that that line itself is a dark green color. That is basically telling us that we have price above a rising moving average. When we have a dark red color like we do right there, it basically tells us that price is below a falling moving average. And you can see here that in each one of these charts, which goes back basically 3 months in time, each one of the candles you see is 1 day. So this is a 3-month daily candle chart in all 4 cases here. That more times than not in the last 3 months, we've had a red moving average. Every so often we'll have a yellow, maybe we'll have just a day or two of green, but this has been a market where we've seen the bears more in control than the bulls. And obviously over the long term, stocks do go up, but in the short term, the bears can certainly win a few battles here and there, and that's kind of the environment that we're in right now. So if you're a shorter term trader, you're probably trying to focus on some of those more bearish areas to be more aggressive and speculate and get in and out very quickly. If you're a long-term investor, for instance, I taught my dividend growth investing class today where we focused on the financial sector, finding a couple of stocks that have long histories of raising dividends, including one I might add that had over 30 years worth of dividend increases and has 0 debt, which is quite rare in today's world. But anyway, if you're a long-term investor, you're looking at markets like this as opportunities to find stocks on sale. Now, that comes with a completely different mindset, obviously. If you're planning on holding for the long term, you're becoming kind of more of a business owner as opposed to somebody who's just flipping ticker symbols back and forth. There's not a right or a wrong, right? So it just comes down to whatever your personality is and what your thought process about the future is. So I would say that if you are shorter term and speculative in nature in the way that you kind of manage your portfolio, then you're probably focusing more on bearish trades right now. If you're longer term, you're probably feeling a bit of pain in your portfolio right now as you see the stocks that you've already bought go down in price, but it's also opening up opportunities in other stocks that might be out there that could have been on your radar screen before then. Remember, where we're at right now is just over 10% from the high of the market. And that's fairly typical. If you go back over history, you typically see at least one event per year where you're down 10% from the high. So I know it probably feels excruciating for some of you if you haven't experienced markets with a lot of volatility before, but this is fairly normal, and I hate to be the bearer of bad news in that respect, but that's just the price you pay when you get into the stock market, right? It comes with risk, and these are the days where you are experiencing that. So anyway, not a great day if you are bullish in the market here today because we did have that pop higher and we closed near the lows in many of our indices. You'll notice that the S&P 500 closed in the bottom half of the range, closed in the lower half of the range in the Dow Jones for today's candle as well. We also did on the Russell 2000, and maybe the NASDAQ fared a little bit better. In fact, the NASDAQ was actually up today. It was up 0.16%. Now remember, it was up higher earlier in the day, so it's not all roses, but I guess if you could say that there was one little element of sunshine in the market today, perhaps it was there with some of those technology growth types of stocks in the NASDAQ. But the other 3 indices did actually close lower today, and quite a disappointment since we were expected at the beginning of the day to have a fairly robust trading action. So we'll have to see how this shakes out, but the main takeaway here is according to the market forecast, we have bearish postures across the board. And so if you're shorter term oriented, those are the types of trades you're probably focused on right now. Let's take a peek here now at a couple of other charts. Let's go over here to our 1040 crossover method chart. We're looking at our same 4 U.S. equity indices on this particular chart. So S&P 500 in the upper left, Dow Jones upper right, NASDAQ lower left, and Russell 2000 lower right. This is chart 4D for those of you that are following along at home that are Premium Market Scholar subscribers. Well, there is more interesting action taking place on this particular chart setup than what we typically can offer you. We've been teaching videos like this or presenting videos like this for many, many years, David and I have. And most of the time when we look at this particular chart setup, it's kind of like watching paint dry because, for much of the last 3 years, now on this particular chart setup, this is a 3-year weekly candle chart here. So it's a much longer period of time than the other chart setup we were just looking at a moment ago. So, over the last 3 years, you can see that there's this one big healthy spot here in the middle that was colored in green. And this is our 1040 crossover method chart here, where we're basically looking at a more sensitive moving average, in this case, the 10-period exponential moving average, and applying that versus a less sensitive moving average, in this case, the 40-period. And when we see those crossovers, it kind of gives us some sort of an indication about long-term posture. And we recognize when we go into these longer term mentalities here that we're not going to catch the market at the low and we're not going to be able to sell the market at the high. That is the nature of you waiting for the crossover itself, because the crossover is made up of previous data, right? So you're not predicting in advance, and that's why you're not selling at the top. So we've had some, destructive price action here for the last couple of months, but it really hasn't been here until just the last couple of weeks where we started to see that negative crossover again. Notice on the S&P 500, which is our chart in the upper left here. For those of you that are Market Scholars subscribers, be aware that I did give you the updated code on our website, and I would encourage you to re-upload that because it should show that you have this death cross that's taking place here on the S&P 500 right now. So let me right-click on that, and let's go to a maximize sell so we can see it a little bit better here. But you'll notice that this orange line, which represents that 10-period exponential moving average, has crossed down and below the blue line, which represents the 40-period exponential moving average. And that is what we would deem a death cross, or what the industry would deem a death cross in this particular case, since we're dealing with weekly candles. So at this point, we want to be a little bit more cautious, even from the longer term perspective. Notice that we did have a period back here, this would have been back in 2016, where we were bearish for, let's call it, I don't know, maybe 2-3 months or so, and then it reverted back higher. So perhaps that's where we're at again here, but obviously it's been 9 years since we've had a true bear market in stocks where we were down 20% from the high in the S&P 500. We got awfully close in 2011. We were 19%. But nonetheless, it's been a while since we've had a really vicious pullback in stocks. So maybe we're overdue. We got to be a little bit more cautious when we start seeing deterioration in price action like we've seen here recently. So just be aware that if you do have a trading policy that suggests pulling back on equities when you have a death cross like we have right now, that you take action according to whatever your investment plan suggests. But again, you're not going to be able to sell at the top on a strategy like that because the moving averages itself are going to lag the price action. So we are finally getting that death cross after actually hitting a high-end price a couple of months ago. Very similar to back here, in 2016, we weren't able to buy at the low. If you were using this thought process, you weren't buying until this candle right here, which would have been, a couple months later, because again, moving averages lag. But in that particular case, you're probably not too you're not beating up on yourself too much because you recognize that, as the years rolled on, you were very thrilled with the gains that you got after this moment in time as well. So just a recognition of what your expectations are and different things like that. But be aware of it. We do have a death cross in 3 out of our 4 major indices. We're not quite there on the Dow Jones yet. So let me kind of zoom in on this one. I'll right click and go to maximize sell. Notice that this one, we are just hanging by a thread. That's why we have this MACD2 lines down here. So that should kind of give you a cleaner view on whether a crossover is taking place or not. When that black line goes down below that kind of horizontal pink line, there should be a crossover of the 2 moving averages up there. So you're basically right on the verge of it. It would take a pretty dramatic reversal higher in price for the Dow for it to kind of save itself, because the natural momentum of the moving averages will likely carry that through so that it will have a crossover here in the next couple of weeks as well. So that is somewhat new news that we don't get to report all that often because, like I said, there was, basically 3 years or at least 2.5 years where there was no change in that particular indicator. And now all of a sudden here within the last month or so, we're starting to see that flip back and forth and back and forth. Kind of on those same lines where we don't see indicators changing all that much, but we do have some fresh information to share with you. I did want to bring up our chart on the yield curve. So that's going to be chart 4J for those of you that are Premium Market Scholars subscribers. Now you'll notice I've got these labeled up here at the top and it's color coded according to kind of what duration each of those US Treasuries is with these lines that you see down below here. Now this is a 20-year chart that we're looking at just to kind of give you an idea of some prior times where we've had some inversions taking place. Now down below, plotted down below here, is a very specific yield spread, and this is your 2s and 10s. And specifically on that particular idea on whether that is inverted yet or not, we're not quite there. As you can see, this blue line hasn't quite touched this pink line here. But as you can see up above here, we do have some inversions taking place. In particular, this green line is just crossing now below this purple line. So you'll notice that the green line is the 5-year Treasury yield. The purple line is the 2-year Treasury yield. So getting awfully close. Wouldn't be surprised at all if the 2s and 10s eventually do kind of have an inversion here. And as a reminder, that's usually a bad sign economically. Notice that we had an inversion that took place as the blue line went below the pink line way back here during the dot-com bubble. And then we had another kind of longer period of inversion where you had the first bout of it here in 2006, early 2006, and then it kind of uninverted itself, if that is a word, and then it went back to that inverted state again late in that year. But keep in mind the stock market didn't start really tumbling until way back over here in 2008 and 2009. So, that's one thing that you want to keep in the back of your mind as well. Inverted yield curve typically is not a great sign for the economy or for the stock market, but it's not like a light switch. When you get that inversion, then all of a sudden stocks just start diving. It might kind of feel like that right now, but history suggests that hasn't actually played out that way in the past. But remember, for those of you that have this chart set up, you can kind of zoom in if you want to see this in a little bit better detail on just the most recent few weeks or months like I've done just there. And here you can see it in a little bit better where that green line has now crossed down and through that purple line. So that's that inversion that you might be hearing a lot of people talking about these days. That's been hitting kind of the business news channels and the Wall Street Journal and different media publications and things like that. So specifically the inversion we're dealing with is the 5-year and the 2-year. But the more kind of critical one that a lot more people focus on, the 2s and 10s, has not actually inverted quite yet. Nonetheless, it is applying a tremendous amount of pressure on the financial stocks. I don't know if the financials were the worst performer today. Actually, they were. I knew they were down because I saw a bunch of those banks getting flashed across the little ticker on TV. But here we can kind of prove it out as we look at the different sector ETFs. You can see that the financials were down nearly 1% today, whereas on the upside we had some of those more safe haven areas like your utilities and your consumer staples and your healthcare areas. So this is a market that is kind of shunning those banks that typically do better if the yield curve is steepening rather than flattening like we've seen here in recent weeks and months. You'll also see that other areas that were struggling today were the materials and the industrials. So it kind of is a mini microcosm of what's been happening here on a longer basis as well, because remember, I do produce that sector selector each weekend in anticipation of my Monday top-down trend trading class, where we use the data for that. Remember, those of you that have access to our premium memberships are welcome to look at the bottom half of it as well. But for everybody else, I kind of give them a high-level overview, just looking at the rankings of the sector selector. And what we found here over the last week is much the same as what we've been experiencing in prior weeks. In other words, on a relative basis, this is a market that continues to prefer those kind of more defensive, hunker down, safety types of plays out there. So utilities remains number one yet again. And you can see ever since the beginning of October, when the stock market really started swooning, utilities has been in the number one ranking for every one of those weeks, except for right here. It slipped down to number two for one brief week and then went right back up to number one. Real estate has been on the move a little bit more so. You know, utilities have already kind of cemented their place as a strong sector for many months, but utilities are the real estate, I should say, had to catch up a little bit more so. And you will notice utilities went from the number 3 slot up to number 2. And just to say that one more time, because I think I misstated that. Real estate, so real estate investment trusts are what typically are part of that real estate sector. Went from number 3 to number 2 last week. So utilities remains number 1. Something new took place with real estate going up to number 2. And that means that it had to supplant healthcare, which kind of went down to number 3 at that point. But notice down below here, we've got our financials that were the second to worst, and they fell, yet again. We saw the industrials fall yet again, and then materials are down there as well. So that's why I was mentioning it kind of felt like today was a mini microcosm of what's been happening on a much broader scale, on this particular sector selector ranking system that takes into consideration much more in-depth data than just one day's worth of data like we saw before. So anyway, that's your kind of look at that sector selector right there. While I'm over here on the internet, just a quick reminder as well. Remember, you can watch these market outlook videos here on our website, and when you do, we would encourage you to click like over here on Twitter. You can just click that little heart right there. You can click thumbs up on Facebook for those of you that have accounts there, and then give us a like on the website itself right there. So thank you to the 99 people that clicked like on Twitter for me last time around. And also keep in mind that if you want, you can share these links over here on LinkedIn and Twitter and Facebook as well by clicking those buttons down below. For those of you that are premium market scholars, remember David has his directional option strategies coming up here at 6 p.m. Eastern time, so make sure you're taking advantage of that. Tomorrow he's got his options inventory class at noon, and then I've got my strategy lab class tomorrow night at 6 p.m. So make sure you're taking advantage of all those opportunities as well. Let's dive back into a little bit more analysis on the Thinkorswim platform now. I'm going to get back over here to the charts, and let's kind of roll through some of our 12 grids out there to get a sense of what kind of assets we're moving today. So let's go over here to chart 4E this time around. And as a reminder, when we look at the background colors of these charts, if it's pink, it means we have a bearish posture on that particular security. If it's green, it means we have a bullish posture. According to the market forecast intermediate term line, right? So as we look at this, kind of interesting today to note that the VIX was actually down today. That was a bit peculiar. Now remember, the market was down, but just barely, and the market was up most of the day. So you would have almost thought that the thought process would have flip-flopped a little bit within the VIX itself. You would have thought that the VIX would have probably started quite low, maybe gapping lower, and then kind of crawling higher throughout the day and maybe even finishing in the green. So that was a little bit of a strange outcome of today's trading, is that that volatility and fear actually decreased a little bit today. As we look at some of these other graphs here, one thing that we've all been watching here for recent weeks and months is the strength in the US dollar. That was kind of same old here today. Notice the dollar was up another 0.27%, clearly has that bullish posture and is trading above a rising moving average. And so remember, oftentimes the US dollar is viewed as kind of a safe haven type of a hangout, while there's fear in other parts of the financial world. You are finding that gold sold off a little bit today as a result of that strength in that dollar, but Gold itself is also starting to look more like a safe haven asset and less like a commodity. The reason I say that is notice that gold's chart actually looks pretty strong here. Higher highs, higher lows, above a rising moving average and a bullish posture. Look at its commodity counterparts over here where we've got our ag commodities right next to it and crude oil next to it. Both of those have pink backgrounds telling us that we have bearish postures and are trading below falling moving averages. And so it just kind of depends. Gold can mean different things during different time periods. Right now, I get the sense that people are viewing it less like a commodity that would be negatively impacted by a rising US dollar and more like a safe haven asset that can kind of retain value a little bit when there's chaos in other financial markets that are out there. A lot of people have been looking at treasuries here recently as well. So TLT did close lower today, but only by 0.02%, and a little bit of a bounce there in some of those longer term yields as well. Let's take a look at our next 12 grid here. This will be our foreign stock markets 12 grid. Chart 4F for those of you following along at home. Now this is a pretty ugly scene here, right? A sea of red. Out of these 12 different international stock markets here, only one of them has a green background, and that's Mexico. And I wouldn't really go on record saying that that's a very robust looking situation there. Remember, if it's got a bullish posture right now, it's probably because it's having a bit of a dead cat bounce. I mean, Mexico is actually down about 19% in just 3 months worth of time. So definitely ugly there. Of course, Mexico in the news a little bit more so today, as well as, those politicians wrangling about, whether a wall gets built at our southern border and who pays for it and all that kind of fun stuff. So anyway, Mexico maybe has a bullish posture right now, but it's probably just because it's viewing itself in relation to how ugly it has been in the past. So the fact that it's just been going sideways in the last, let's call it week and a half or so, is positive in relationship to the fact that it was just basically plunging, it seemed like, every day prior to that. So perhaps a little bit of stability there, but I wouldn't get overly excited about that one. As we look at some of these other charts, most of them look pretty awful, right? We're looking at Germany here with a fresh low yesterday. Yeah, we got that oversold cluster signal, so perhaps a reversion to the mean type of a move could develop, but I don't hold much hope that it's going to be able to get above that moving average and stay above it, because the last two times that we approached it right there and right there, we failed. And the same thing can be said right there with the United Kingdom, of course, having been in the news here recently with its Brexit votes. And so the point is, if you're thinking to yourself, I'm going to go outside of the United States to find some stability in stock markets, you're going to have a hard time finding it outside of the U.S. as well. Brazil and Russia are more sideways. So notice that these charts are, Brazil had that nice boost earlier in the fall, and it's done a good job maintaining that strength. It hasn't continued the strength, but it's at least maintained those price levels up there. And that's more than we can say for most other equity markets around the world. So I'll give it credit for that. And Russia has been more of a sideways trending market as well, whereas a lot of those other markets have been a little bit more downward pointing. Let's now take a look here at 4G. This will be our U.S. markets from a sector perspective. I mentioned the utilities that were the #1 slot on my sector selector for the umpteenth time. Well, shouldn't be a surprise to see the utilities up yet again today. XLU up 0.41%. Actually looks like a strong chart, right? The valuations may not be all that great in the world of utilities anymore now that their price has gone up dramatically. But it is being viewed as a relative safe haven in times of turmoil, with the thought process that people don't turn off their lights during recessions, right? People will still pay their electricity bills. So, sometimes you find these, really strange markets where, investors are throwing away growth stories and going towards what would be seemingly mundane and boring in order to kind of retain the value of their portfolios a little bit more. So, utilities and real estate have been a couple of the areas we've been focusing on a little bit more so in my Monday top-down trend trading class as a result, and we're thankful we have. They've done a good job of hanging in there where a lot of other sectors have really started to falter. Now, you'll notice that the materials is one of those faltering sectors. Notice it has that pink background telling us that we have a bearish posture on it. It was one of the three down sectors today as well. It was down 0.33%. So I wanted to focus today's trading application within that particular area. So I'm going to come over here to chart 4A just to pull up a one grid on the market forecast indicator. And I'm going to pull up ticker symbol VMC. This is Vulcan Materials. And you'll notice that earlier in this 3-month chart, it was in quite a nasty downtrend. That would have been during this period right here, kind of early to late October. Things really were struggling. It then kind of bailed itself out with a nice earnings announcement, presumably, because the stock price did revert back to the mean, but it kind of gave up its steam. And you'll notice that it's been more traveling sideways here for let's call it the last month and a half or so. Well, you'll notice that with the trading action of the last few days, we now have this bearish posture back on VMC. And with today's action in particular, notice that it was down 1.85% today. It was trading basically at its lowest closing price, going all the way back to this time period way back here in October. So it seems to be a little bit more stress taking place right there on VMC. You'll notice that the blue line and the red line are in the lower reversal zone, showing you some pretty extreme price deterioration. And of course, as I mentioned before, the green line is also trending lower, telling us that from an intermediate perspective, we're expecting bearishness out of this one as well. So what I thought we would do with VMC here tonight is take a look at a long put spread. Now notice that we closed at 99.66, which opens up a nice possibility to kind of flank a nice round number of 100 when we're going to be structuring a spread, which can be helpful in times like this where maybe it's not the most liquid security on planet Earth. Now, it does have several hundred contracts in the open interest, but it's not Microsoft or Apple or Google or different things like that. So anyway, as you can see, I've kind of loaded up the trade down below here already, where I'm going to be the buyer of one $105 put in January. So I'm looking at the January monthly contracts with 38 days left until expiration. So I'm buying the 105 put, which remember, when you're a buyer of puts, that's a bearish trade. But I'm going to partially offset the costs of buying that put by selling a lower strike put at 95. Now what that does is it limits my profit potential. So if you think that VMC is going to just outright plunge, you wouldn't want to do a trade like this. But if you just think it's going to continue to meander lower throughout the next 38 days, then perhaps it's a trade that can make some sense. If you start going below 95, you're not going to really make a lot more money beyond that point. So you're kind of limiting yourself between where you're at right now at about $100 going down to 95. And again, if you look at that chart, you can see where we're at right now is about right here where I'm kind of circling, and your bogey, what you're shooting for, would be about 95 right here. So again, if your expectation is that this thing is just going to completely collapse and go down to 80, then you're just going to want to buy puts outright. You're not going to want to buy a put spread because you're limiting yourself. On the other hand, if you just kind of get the sense that it's going to meander lower here in the next 38 days, then perhaps that trade can make some sense. The other thing that I kind of was interested in it for is the fact that you'll notice here that you're only paying $4.85 out of your pocket to access this debit spread. Notice that VMC is already trading below $100 per share. So remember, think of it in terms of really easy math. Let's pretend that Vulcan Materials was trading exactly at $100 even as of today's closing price. Then, theoretically, you should be paying $5 for a $105 put to kind of get it back down to that particular level. So in this particular case, you're getting a little bit of a benefit there because, your break even, remember, you can always get your break even by clicking confirm and send. Your break even right here is 100.15. Remember, this is a bearish trade. So you're already trading below that. You're already, if this thing, we fast forward to the expiration in January, 38 days from right now, and it's trading exactly at 99.66, you've already made money on that trade, right? Because you just need it to be below $100.15. So I kind of like those setups. I know it's not, a huge win, right? You're only talking about, what is it, about 50 cents or whatever it is there, but 50 cents is better than nothing if you already have a specific posture that you would have been willing to take the trade anyway. So we'll just do one contract there and see how we do on this bearish trade setup here on Vulcan Materials. It's a long put spread where we're buying the 105 put in January and we're selling a 95 put in January with a debit of basically $4.85 coming out of our pocket. All right, so let's wrap things up for the day. It was another disappointing day, without a doubt, at least if you want to be bullish on the market. This is a market that is being more controlled by the bears here recently, and the fact that we closed near session lows here today kind of proves out that point. So remember, if you're more speculative in nature, you want to be more active with your trading style, you're probably focusing on the bearish side of the market. On the other hand, if you are more of a long-term investor, then perhaps you're going to uncover some hidden values out there as prices of stocks come down along the way as well. So as always, I want to thank you for tuning in. David will be back with you tomorrow. Remember to check out our classes for those of you that are premium market scholars as well. And remember to click like and retweet and all that fun stuff on social media if you get value out of these videos and you want us to continue them going forward. With that, all the best success with your trades and your investments. Goodbye for now.